Hey everyone, it's Jason here from Modern Money Method, and wanted to bring you an investing video. Something that you hear people say a lot is it's about time in the market, not timing the market. And I'm going to tell you right now, that's 100% fallacy. Um, what I made here was a chart of the last 20 years, and what we have here is we have the S&P 500 index. I just consider that the best long-term tracking stock market index. If you are going to be super lazy and just put your money in the market and not make any mental decisions whatsoever, go for the S&P 500 index. It'll do better than the Dow. It'll do worse than the NASDAQ on the upswings, but better than the NASDAQ on the downswings. So what we have here is we have the index value from the last 20 years. And as you can see, it's been quite a good run. It was 1,212 in 2004, and today we're at 4,157. Now, I do want to say something right here. I would consider, if you are in, you do have to have skill to get back in, though. Now is a great time to get out of the market. And what I mean by a great time, like people say, you put your money in and you keep putting more money in, um, and you just always stay in. Okay, well, here's the drawback to that. There is many times throughout a cycle of a few years when you can tell that stocks are overpriced relative to other items. And so what I mean by that is I believe that you have a 98% chance that if you were to sell here today, it's been as high as 4,200 a couple days ago was definite sell point. You'll be able to buy back in 5% less. And you're like, oh, what a lot of work, Jason, to buy back in at 4,000. Well, let me tell you something. If you were to just do that a few times over a decade, what's happening is you're getting out at a certain point and then all your money is going back in 5% less. What that means is I'm going to show you how that works. So $1,212 put in 2004 would be 4,157 today. And we're only going to talk about those numbers because I just want to show how powerful it is to be somewhat of an active investor versus just putting your money in and sitting in all the time. Obviously, it hasn't played out too well for people who put money in 2020, 2021, 20. You're not up much at all, in the last 3, 4 years. What I have here is basic in and out timing. This is for someone who's just barely above super lazy. And all I have, so I've tracked markets for over 40 years. It's been a passion of mine. I find them very interesting. And all that happens, all I did in this one is I didn't even want to stress anyone out. I just basically, when the value of the stock market in relation to earnings and other things got to the very high end, I just put here that you got out of the stock market. I didn't even put that you do anything else with the money. Basically, you just park it over on the side. You earn no interest. You don't invest in treasuries or T-bonds or commodities. All you do is get out of the market. So check this out. So this, over a 20-year period, you only had 8 times that you got in or out of the market. So you only have to make 8 decisions in 20 years. And what happened here, so you got out in 2006. This was an obvious point that the market was way overpriced. Now, you would have missed out because it went all the way up to, I think, about 1,500. So you would have looked dumb for a little while because you got out at 1418. As you can see, we sat out 1418, 1418. But then you looked pretty smart as the market went down to 900. And you couldn't quite tell if that was the bottom. So you didn't get in there. There were some signals in 2010 that it was time to get back in. So you parked your money outside the market for 4 years there, got back in at a lower price point. See that you got out at 1418, but you're buying the S&P now at 1115. So you have an advantage because you're buying back in at a lower price point. So now you're in and you ride that up, and 2014 gave another signal to get out. Now, that signal didn't work out that well because the market actually kept going. But in 2016, things said to get back in the market. So you were out for 3 years. See how you got out at 20? This is your value of your $1,212. So you got back in. Then you rode the stock market up, and there was signals to get out in 2019. So at that point, you got out, and that is too bad because the stock market, with all the money they pumped in during 2020, went up quite a bit higher. So you did miss that move up. You were out during that. But then the signals in a mid to late 2020 said to get back in. But then, if you remember, I made a number of videos in October, November, December saying, hey guys, this is a medium term, long term top in the stock market. The NASDAQ was at 16,000. The Dow was at 36,000. The S&P was at 4,800. I said strong out. And you can see over here this is how I trade. I got out right there. I said get out. And look at that. So you would have taken your money out, and people be telling you time in the market, but you'd be out of the market for 2 years and you'd still have more than the S&P is worth today by about 15%. You could have taken that money and put it into something else. But like I said, this column here is just out, the out column. So you got out right here, avoided that downturn, got back in. And so what we have here is we have just these minor ins and outs, basically get out when the stock market is high, get back in when it's fair or low valued. And like I said, we missed the bottom. We got out before this run up here. It's not perfect, but look at this. You're only in the market out of the 20 years. Actually, let's look at it. So 4, 5, 6, 7. You're only in the market 12 of the years versus over here, you were in them, all of them. And look at this. You're up over 25%. You have more money than you did over here. Now, if you do that over a 30, 40-year period, if we extrapolated this out, the reason it's very important to make these little moves where you either lose 5% or 10% less than you would have, or you gain 5% or 10% more, only have to make a few of those moves. And over your life, your investment account is going to crush the stock market in whole. And that's basically a Warren Buffett move. He doesn't make those moves as much anymore because he has a very large fund. But if you look back 30, 40 years ago when he was trading, he would get in and out of the market at different times to do exactly this because he realized, hey, there's going to be a better time to buy. Like I said, right now, I don't have it out over here showing, but if you're in the market, I would say you have a 98% chance you're going to be able to buy the S&P for below 4,000. And that might sound very minor to people, but you're talking about you made, when you don't lose 5% on your money, you actually made 5% on your money. All right, let's move over here to the last class. And I'll tell you, this one is actually very simple as well. This one, I track multiple things. The main one, again, is the valuation of the stocks. The secondary thing, if you don't know what else to put it in, you hop over into treasuries. And the other thing is commodities. Uh, those are big drivers in the economy. Just think about it. Oil and foodstuffs and metals, all kinds. Look at the price of copper. Look at the price of zinc. Look at the price of gold. So this one actually has you in the stock market very little of the time. In fact, you can see here you would have been in the stock market from 2004 to 2006 and you would have been out, and you never got back in the stock market again until 2016. You were out for 10 years. There was other investments to be invested in here, not stocks. And check this out. So you got out at 14, 18, right along with everyone else. You got back in with your money of $3,774 while the S&P was only 2,200. So you outgained the S&P by not being in the stock market for those 10 years. So then you were back in the stock market and there was a signal to get out again in 2019. to get back in 2020 and to get out the fall of 2021. So, and since being out of from the fall of 2021, we are not in the stock market. So on this chart here, we've only been in the stock market 3 years, 4, 5, 7 years out of the 20 years. And look at where we are at. Your $1,200 would be $9,202. And this is not making daily moves, guys. Do not be fooled by these day traders, meme stock guys, Wall Street bets, and all that. That's just entertainment. This is literally making one move a year, maybe two moves a year. Some years, no moves. You get over. There was a time here, I believe it was right in here. You could buy some 4%, 5% treasuries, and those returned you 4 or 5% for a couple years. So you just sat in treasuries, made 10% on your money. So anyway, I just wanted to share that with you guys. If you ever want to know more about this, reach out to me. This is just something I'm super passionate about. I've done it my whole life. I actually managed a small hedge fund at one time, and since then I've just traded my own personal account and a few close friends' accounts. I just tell them when to make the moves, and they have experienced these gains, that are quite dramatic over a period of time. In the short run, might not look like you're doing, the greatest thing in the world, right? Like, right here, let's just look at some stuff. Uh, this one here, the very simple one, sometimes you're actually, behind, or you're not very far ahead. You're like, wow, Jason, you have me doing stuff. Look, we're only at 2,600 compared to 2,200. I should just put it in the stock market. But look what we've done since then. We've gone all the way from 2,600 to 5,100. Now, if you want to get over here with me and be a little more active and a little more open to those other investments, this is what you can experience. And don't belittle this. This is a sevenfold on your money in a 20-year run, and we're going to do that again for the next 20 years. So, and even if you get in here in these areas, like look at this. I want to show you something. So like right here, 2014, the S&P was at 2000, okay? Look at this. It's only doubled in the last 10 years. It's at 4,100. But you go over here to my account and you would have 3,600. In the last 10 years, we're at 9,200. Doubling would be 7,200. These little extra 2, 3, 4% per year gains, those when they stack and compound on top of each other, give you long-term outperformance over everyone else. All right, make it a great day. You can contact me. You can find me all over the place. I'm involved in real estate, finance, and just generally helping people.